I think I've made just about every mistake you can make while trading options, and I always learn from my mistakes, most of the time. If you've been trading options for some time, no doubt you've made mistakes as well. Let me know your biggest mistake in the comments below. Biggest mistake wins. All right, in this video, we're going to cover the biggest mistakes that new option traders make. If you're new or learning options, you're definitely going to want to watch this. In this video, we're going to lay out the top mistakes beginners make when trading options. All are equally important, so be sure and watch to the end. Hey guys, Darren here. Thanks for joining. We talk about ways to increase profits and reduce risk in your options trading portfolios. I promise we're going to dig into many detailed tips and tricks to help you with your daily trading of options. If you haven't subscribed yet, please go ahead and do that now. All right, it's super important to understand the mistakes that we make when trading options. Why do you think that is? So that we don't continue to make the same mistakes over and over again. And more importantly, what do you think is the most important reason that we want to understand our mistakes? We lose all our money. We don't want to lose all our money where we don't have more money to make more mistakes. All right, before we get started, be sure and download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. Please tap that like button and let's begin. Mistake number 1, not planning your trades. Failing to plan is planning to fail. I think my dad used to tell me that. Having an exit strategy in place before you ever make a trade is extremely beneficial. Successful people tend to have plans and then go about setting small goals that lead them towards accomplishing their larger goals. Yeah. Trading can be emotional, both when trades go for you and when they go against you. You don't want the stock to move against you and then just double down and hope it goes up. You also don't want to have a big gain and then just add to it thinking it's all roses. You'll be in a much better position to make a good decision before the stock moves for or against you. Mistake number 2, trading illiquid stocks. New traders often don't trade liquid underlines. What I mean is they don't trade the big stocks like Apple and Amazon that have high volumes and are very liquid. Instead, they try to pick the next big winner that's going to go up 100% or more. Remember Wall Street Bets, the meme stocks, AMC, GameStop? Yeah, let's buy some calls. They are going to the moon. Yeah, good job. So once you get into an illiquid stock, it's tough to get out without giving up a lot of money. Let's look at an example of an illiquid stock on the Tastytrade platform. It's the best platform for trading options. I'll put a link down below and you can get a cash bonus when opening an account. I actually really like this company, Illumina, as they are the global leader in DNA sequencing. But unfortunately, you just can't trade the options. The bid-ask spread is just too wide. We see the trading volume is just 100,000 shares, which is very low. We generally like to see over 1 million shares traded. Taking a look at the 180 put option, we see the bid is $1.75 and the ask is $2.85. Now, the difference between the bid and the ask price is money that's just flushed down the toilet. In this case, it's the $2.85 minus the $1.75 or $1.10, which is really $110 since one option contract controls 100 shares of stock. Now, in looking at Amazon, we see there are over 20 million shares traded. And looking at the 110 put option, we see the bid-ask spread is just 2 pennies wide. So we're only giving up $2 when placing the trade. Bottom line, you will only be able to close or roll positions at a very unfavorable price if the options in the underlying stock you are trading are illiquid. We need to target only trades with high options volume and narrow bid-ask spreads so that we are not giving away free money. Mistake number 3, too many underlying positions. It's hard enough to do the research and pick the right stocks. You want to look at the technicals, the fundamentals, as well as the earnings and the conference call reports, even the news around the stock. Sure, it technically should be all built into the stock price already. The point is, it takes some time to learn and really understand about the companies. However, going back to the previous mistake, we can immediately eliminate stocks that are illiquid. I like to have a list of stocks in different industries that are liquid that I like to trade. I then decide if I think they are undervalued, being the stock price is too low, overvalued with the price too high, or fairly valued. I started with just about 10 stocks. Then I got to know about 20, and then finally about 30 or so. That's about all we need. That's plenty of opportunity if you have between 20 and 30 stocks that you watch. At any time, you may only have on trades in about 10 or so because the IV is good or they're just undervalued or overvalued and you see the opportunity. I use bullish strategies that will make money when the stock price moves up for the undervalued stocks and vice versa, bearish strategies for stocks that I believe will move down. Mistake number 4, trading too big. No more than 5% in any one position. I've heard it over and over. Do you think I listened? Or do you think I had to learn it the hard way? Are you guys going to take my word for it? Probably not. Will you learn from it? I hope so. Trading too big can be both a mental and financial challenge. It's mental in the sense that it's sometimes hard to have emotional control to handle the large losses, and it can be financially challenging because if you don't have adequate capital to back up your trades, you'll end up taking on too much risk with your investment dollars. Always know where you'll be P&L wise in your portfolio should an unfortunate catastrophic event occur and the market drops 20 or 30%. We never know when there will be another war or political event or even a pandemic. Hopefully not anytime soon. Every few years, something happens that causes the market to drop significantly. Even if we have uncorrelated positions, when an event happens, everything suddenly becomes correlated and all positions go down significantly. We need to be able to stay in the game by not over leveraging. These are the times when we want to have cash available to invest while everyone else is panicking and getting out of the market. I recommend always having about 50% of your buying power available when the market is average or above the historical averages. Since we are trading options, we are already using leverage, so we can outperform the market and stocks using much less capital. So there's really no reason to use more than 50% of your buying power. Beginners often have a little success and see the big gains and the potential and become greedy. They often don't realize that they are going too big until it's too late and something happens and they lose everything. That said, if the market has already been hit with a 20 or 30% downside loss, then we may be safe having 70 or 80% on at that time with more positions leaning long. On the other hand, if we're at all-time market highs already, then I like to stay fairly small. If we're not able to sleep at night because we're worried about our options trading account, then we're likely trading too big. Only when we're comfortable with the daily fluctuations and know that we can withstand any downturn can we make correct decisions based on probabilities in our favor. It's when we get too big for our britches that we feel like we're invincible and we make mistakes. Mistake number 5, not understanding implied volatility. Understanding implied volatility is important when it comes to option trading. Implied volatility is an expectation of where the stock might move in the future. Depending on how high the implied volatility is, it will cause option pricing to increase or decrease to compensate for the volatility. When implied volatility is high, then option premiums are high. And vice versa, when IV is low, the option premiums are lower as well. So if we are selling options, which is what we want to be doing most of the time, we want IV to be high so that we collect more in option premium. So stock volatility is a measure of how much a stock's value fluctuates up and down. If the black line is stock A, then you can see that it has very little volatility and stays in the 100 range. The frequency and magnitude of its moves are very small. Stock B in the blue has much higher volatility and makes bigger moves even though it ends up at the same $100 price. Mistake number 6, using the wrong option strategies. We've talked about it in previous videos. For the most part, we want to be option sellers collecting premiums with high probability of profits as opposed to buying options. We want to do this when IV is high so we collect good premiums. By selling, we can have a 70, 80, or even 90% chance of winning depending on the strikes we choose. Whereas buying options is like gambling, throwing your money away for the most part, for only a 20 or 30% chance of winning. You can very confidently make a good percentage return on your portfolio when sticking to the one consistent strategy of selling options. It really takes the gambling aspect out of trading and puts you on the side of being more like the casino owner collecting the premiums as opposed to the gambler, or the insurance company collecting premiums month after month as opposed to the person paying the insurance premiums every month. We do want to be on the winning side, right? So we sell options with high IV and use strategies like selling puts, calls, strangles, and iron condors. So do we ever buy options? The one time that I like to buy options is when the IV is low and I find a stock that has been really hit and is at all-time lows. If I have done my research and I'm confident that in the next 12 months the stock will be at a much higher price, I'll use one of my favorite option trading strategies. I'll buy a LEAPS option at least a year, and normally I go about 2 years out from expiration. If you're not familiar, I'll put a link down below to a video explaining the LEAPS option. It's a great way to control 100 shares of stock for less than half the cost of buying the stock outright. It also reduces risk over just buying the stock outright. You can also sell a call against your LEAPS option and collect passive income as well. Mistake number 7, buying high and selling low. What do you think people do when there's a hot stock that is skyrocketing up? Maybe a stock like Nvidia. They're a pure AI play, artificial intelligence, which is huge right now. They buy into the hype, right? Right at the top of the market. And then the price starts to fall and they panic and they go, I got to get out of this thing. And this thing's dropping like a rock. So in the end, they end up buying at the highs and selling at the lows. I thought it was supposed to be the other way around. Guys, it is. We need to sell options at highs and buy to close when they are low. So how do we do that? Like discussed previously, we have a plan and track the liquid stocks we want to discuss. We then place bullish trades in undervalued stocks we think will go up and bearish trades in stocks we think will go down in price. We can use GTC, good till canceled orders, to buy and sell at the prices we want. Let me know in the comments below if you'd like to see a video on the advantages of GTC orders. We also let our winners ride and cut our losses short. This may seem counterintuitive. There seems to be a trend to stick with losing trades and cut winners at 30 or 50% profit. Don't get me wrong, any profit is good. However, if we're taking 100% losses and then only having 50% wins, we're not going to do very well. So we want to cut our losses short. Too often in the beginning, when I was making this mistake, I would be on the losing side of the trade and I would wait and hope that the trade would come back. And I'd end up losing even more. Well, if you liked it at 120, you should like it a lot more at 105. Yeah, but I like it even less at 95. What I found out is that if I set a limit in the beginning of how much I'm willing to lose before cutting, I'm much better off. If I miss on a trade, so be it. There are many more that I'll win on, and I don't want to lose too much on any one trade. Now on the other side, when you're in a winning trade, you don't want to sell too early. Countless times I've been in a winning trade and closed at 50% when I could have made 100 or 200% profit. Again, GTC orders can help this by locking in gains and still letting the winners run. So bottom line, we're trading options to make as much money as possible. We do that by cutting losses at our limit quickly and letting winners run. Mistake number 8, not tracking your trades. Remember step number 1, having a plan? We not only need to have a plan, but we need to track our plan and measure our results so that we can make adjustments along the way when necessary. I noticed after I began really tracking my trades that I often wasn't even aware of the results. I'd get wrapped up in it and would overlook losses if I thought off the top of my head, hey, I made a good trade. It's just down a little right now. It'll come back soon. Just give it some time. Then I noticed, because I'm tracking, that, hey, this happened last month too. That's kind of weird. It works the other way too. Sometimes you don't even realize it when you trade a certain underlying. Every month you're having a winner. So what I do in that situation, I'll look to put that same trade on again and again whenever that opportunity arises. Sometimes I'll have that trade on all the time. Some people like to physically write their trades down in a notebook. I like to use a simple spreadsheet on my computer. It really doesn't matter which way you go about it. I write down my entry plan as well as my exit plan on one spreadsheet. I have each underline listed, the P&L open and the P&L year to date, why I put the trade on, and when I will close out and exit the trade. After exiting the position, I can see if I accomplished my profit goal. I make notes why or why not and document exactly what happened. I can then clearly make a decision of whether or not I want to trade that position again and under what circumstances. I can check my spreadsheet prior to placing any trades in the underlines since I've got documentation. Without the spreadsheet, there's probably no way that I would know. All right, guys, question of the day. What option trading mistakes have you made? Let me know in the comments below. This is how we all learn together. All right, I put a link down below for the free options workshop. Be sure and grab that. Please hit like and subscribe and share with a friend. I will see you in the next one.